Good afternoon, everybody. Welcome to another edition of the Smoking Barrel. I'm Rustin Edwards, based in Geneva, with my illustrious co-host and partner in crime, Mr. Matt Stanley.
Morning, you TSB legends.
First thing to note, we want to give our hopes and prayers for all those who have been impacted by the earthquake that's hit southern Turkey and northern Syria. A lot of devastation, a lot of damage, and a lot of people are going to need some support and some help. So if you have the means and the wherewithal, please reach out to the Red Cross, Red Crescent, or any other organization that you know to help those families and communities that are going to be in need.
Yeah, second that. God bless you all. It's a terrible start to the year for those poor folks. So anything anyone can do, please do it.
But on another note, as we assess the impact of the earthquake to oil markets in general, the one thing of note is the suspension of operations at the Turkish port of Ceyhan. Ceyhan is one of the big load ports for the BTC pipeline, as well as the Kirkuk-Ceyhan pipeline. Approximately 1 million barrels a day loading out to a variety of ships in that southern port. And as from what it seems right now, the Iraqi Kirkuk pipeline has some pipeline damage, and they're estimating that's going to take anywhere between 2 to 3 days for the repairs to be affected, while the BTC pipeline from Azerbaijan looks like it's operational and pumping oil. So if anything, that's about a 400,000 barrel a day decrease in flow into the port of Ceyhan. On top of that, you've got the weather issues in Ceyhan this time of year, so that's also delaying loadings. But that's kind of more market expected versus market unexpected, like the earthquake was.
Yeah. Look, it's always a tragedy. Well, the whole thing is a tragedy, what's happening, like we said to start, but it has its effects on commodities and flows and what's loading and how it will load. And crude oil, traders are always reluctant to attribute a natural disaster but to why price is going up. But look, supply issues in what we are now is a fairly delicate, balanced market. We'll talk about that later. But yeah, look, seasonally, Dortiol, Ceyhan round there, Skenderan, it's cold. I mean, to say the least. Syria has obviously had its issues. It has done for the last couple of decades. It's not far from Aleppo. So yeah, look, initially, I think the market thought that there was no damage. It was business as usual, move on, nothing to see. But then it's emerged today that there obviously is a bit of damage. It's a very important choke point, as you said, for Kirkuk crude, the Kurdish material coming out through Iraq, through the pipeline. We're seeing a lot more of that material. Well, actually, no. I'm surprised more Iraqi material hasn't been going to Europe, flowing through that pipeline, because obviously what will happen with replacing Russian crude, a medium Basra, which is a grade of crude that comes out of Iraq, is a fairly good replacement for the Ural slate. So it's a puzzling one why Europe hasn't been buying more of it. But yeah, look, that's why flat prices.
But the Kirkuk pipeline, it is only about 500,000 barrels a day. So, I mean, they were pumping, say if they're doing 400,000 barrels a day, they're pumping fairly close to capacity of that system. I mean, I think Kirkuk can reroute back down to the port of Basra if the outage is out longer than necessary. But all it does is increase the ton miles that are going to need to move that crude. And as you said, it's a replacement for Urals. So it's just a matter of, the convenience of loading a Suezmax out of Kirkuk, out of Ceyhan versus loading one out of Basra and going all the way around through the Suez Canal to get back into market. So you extend the lead time of the crude from 2 days from load to 12 days from load. And that does add significant ton miles and more upward bias towards freight if the damage is far greater than the 2 to 3 days of repair that the BTC consortium says that it's going to take.
I mean, go on, mate.
I said also impacting supply was the Johan Sverdrup shutdown, which coincided pretty right on with the shutdown of the Ceyhan port with the earthquake. Phase 1 platform experienced an electrical fault, which shut it down at least now for 3 days. It's expected to return to full production starting today, but haven't seen any headlines on that one yet. But again, that takes another 500,000 barrels off the market. as that was a fairly robust field for Norway.
Yeah, I mean that's obviously, yeah, you're right. These issues manifested themselves as one, and yeah, I mean, oil's we dropped below 80 at the end of last week, and now we're $84.20. We were up to just under 85 earlier. So yeah, I think I don't want to say the word much needed, but for the bulls, it was a much needed kind of supply disruption. They don't need much of a reason to bid it up, but yeah, I think
Well,
Brent.
it definitely gave the bulls a nice counterpunch to the U.S. dollar story and the Fed and the U.S. jobs report, which basically deflated a lot of the bullish sentiment across commodities and across stock markets in general. That jobs report on Friday blew everybody out of the water with the 517,000 new jobs created in the U.S. for January, and then the upward revision for both November and December. Both
Yeah.
both put traders on back feet, saying, "Oh, it looks like the interest rate hikes are not going to stop after all."
Yeah, I mean, it's a case of good news is bad news, isn't it? I mean, the usual yeah, nahs. But I mean, it was what 370,000 more jobs were created than usual. Grandpa Joe was very excitable this morning, or last night in his State of the Union speech. One stage he was giving it this and that to a load of people, and I thought, is he going to tell a joke or is he going to talk about the USA and politics? But it was quite funny actually. I mean, talking about binding the Republicans and the Democrats together, okay, but yeah, look, no one's really worried about that from a trading point of view. But what Jerome is going to do with his disinflation nonsense, yeah, look, this is what what we're talking about. There's so much unknown right now. To start the year, what does inflation look like? Have interest rates peaked? Have wages kept up for this cost of living crisis? What's going to happen with Russian energy? What's going to happen with gas stocks in the EU? There's so much that people are waiting for that I just feel like it's getting a little bit, it's getting to the point a little bit where traders are starting to tap their fingers on the table, going, right, okay, I'm getting a bit itchy now. And I think there's just one point, there's a pivot point, and I'm not sure what it is. There must be a data point that really drives the next wave on where flat price goes in terms of Brent. Because right now we've been between 80 and 85 really for the whole year. Okay, we've had the odd day here down to 77, the odd day here up to 86, but essentially it's been between 80 and 85. It's been a fairly boring range. What is that data point?
Well, and there is a lot of conflicting data driving bulls and bears. I mean, you have the big bullish sentiment on potential Chinese recovery and what is China demand going to look like in a post-COVID market. That's still a lot of speculation out there. I mean, you can point to mobility data or whatever else you want to point to say, well, potentially we could see X amount of growth. And I think most people are expecting to see a demand increase anywhere between 500,000 to 900,000 barrels a day just in China alone. Just depends on when does that demand materialize, if it does materialize. Because I've said this before, at least on the Chinese demand question, there was a lot of other headwinds to the Chinese economy that have to be sorted out in order to make that demand real. I mean, if you look at forward freight rates right now in containers, I mean, the Shanghai to Europe freight rate is down to $920 a TEU, based on information from Clarkson's. I mean, when you got container rates at that type of level, that tells you there's no factory output really producing yet in China that increases the demand for exports to go out, and there's no demand pull causing freight rates to go up either. So, without that global consumer demand coming back in to help support factory output in China, it's really hard to say when is that Chinese real demand going to come in. Yes, there's going to be a spike in demand because of the Lunar New Year, and that spike has come and gone. People went and traveled, saw their families, they came back, went back to their offices, and they're going back to work and getting back into the flow. So there will be an increase in that consumer demand for fuel. Don't get me wrong, I'm not going to deny that it's not going to happen. It's just, is it going to be as robust as a lot of analysts are pointing to? And that's the question I've always had around Chinese demand. When you throw in
Yeah.
the macroeconomic condition, I mean, you've got the Federal Reserve. Powell's statements last night really added more fuel to the fire for the bulls, because he mentioned that inflation looks like it's trending lower. And once those words came out of Powell's mouth, markets just took off, because Powell said inflation's abating. Yet they ignored his further statements, which were interest rates are still going to have to probably go up. The job market is way too strong. So they took the kernel of good news to drive their prices forward.
Yeah, this is the thing. This is it Fed policy that is the main market driver? Is it if the algos are going nuts after Jerome is saying about disinflation? Is that what's moving it? But it's interesting what you just said about the containers, because that is a bellwether for sort of global sentiment, buying sentiment. But I've got another one, and that's, can you book a tee time? Right? Can you book a tee time on the golf course? This time last year, Dubai was absolutely rammed, and you couldn't get a tee time to play golf because it was full of people coming over here on holiday. COVID was still very much with us. It still is, but this time last year, very much. And people bolted to Dubai and thought, I want some winter sun and I want to play golf. And you could not get a tee time for love nor money. People were queuing up on golf holes, and it was like, wow, Dubai is buzzing. And don't get me wrong, Dubai is busy, but you can get a tee time, no problem. And I think that says a lot for how the world economy is faring. I think this time last year, people went, you know what, bollocks to it. I'm going to go on holiday, and I'm going to enjoy myself, and I will worry about paying off my credit card at some point in July. And I think people now are going, yeah, I'm not going to do that again. We had a good time. We've got a good memory. And I think that will be the pivot point when it comes to economic data coming in terms of CPIs and retail activity, that I think will push the Fed more rather than just looking at cost of inflation. Because the inflation cost is more about what's going on with energy, which is settled down. So those inflation data points that are coming in should start leveling off. But I think retail activity and a tourist destination like Dubai, how busy it is compared to this time last year, I think they will be the points where federal policy or Fed policy, fiscal policy, will have to amend slightly.
Well, and if you do look at some of the retail data that has been coming out, I mean, you've got Italian retail sales in December down 0.2% month on month. German retail sales were down as well. I mean, yeah, these are all European basis basis items, but nevertheless, it shows that there is a lack of buying interest here, at least in December, which is Christmas time, which you think that should be the higher buying demand. So, and the one thing when you look at consumer demand in China and other places, China did not have the same stimulus programs like you had in the UK, the US, and the EU, where people were given furlough money or just stimulus money to go and spend as they needed. I mean, I sit here in Switzerland, and I got a stimulus check from the U.S. government. Go figure. But when you have that type of handout, and that kind of drives buying interest, and then you get into the case of here we are now coming out of the Christmas holiday season, and retail sales in December were horrible. I mean, the overall EU retail sales in December were down 2.7% month on month and down 2.8% year on year. Now, when you take that type of data over the EU full, it tells you consumers just aren't buying. I mean, consumers have become more retrenched in what they're looking at, and that's going to be because the cost of living has gone up, and people were afraid of energy spikes, which are still there in the marketplace, and people have had to try to cover.
Yeah. I mean, look, this is the thing. It's I don't know, and this is why it's very difficult to opine on or comment on, because everyone's got a theory. Of course you have. Traders love them. That's a reason that right, I'm definitely going to buy this because of that reason. And then it doesn't happen. And you go, oh, I didn't think it would anyway. You come up with some other crap excuse as to why you got a $10 million hole in your P&L. But, there is so much ambiguity and so much unknown that I'm not sure those positions are put on. I mean, if we break it down to the prism of what we were doing, trading, looking at who's doing what patterns, fundamentally, there is enough oil. And the concerns we had Q2 last year when oil Brent went to $140 a barrel on supply shocks have not materialized, but Brent remains stubbornly in the mid-80s.
Well, but you can say that it stays there because we've had a narrative shift. Because if you remember back in December, we had a nice pullback on crude, and then China decided, okay, no more COVID restrictions. We're opening everything up. And as soon as that headline comes out, the market took off because the narrative changed to, oh my God, there'll be so much demand because China's coming back. You have to buy it. And that's what I think is still providing the support in the marketplace, despite the fundamentals that stocks are building around the world. You've got build up in distillate stocks, build up in crude oil stocks, build up in gasoline stocks in the United States. It is still the underlying current that China is going to come back. China is going to drive global demand. China is going to be there for 900,000 barrels a day of consumption. You cannot not own it at this level. It's cheap. Now, if you buy,
are you a buyer or a seller here?
I would actually say that I'm more neutral to negative than I am bullish.
Oh, come on. We didn't do this podcast to sit on a fence, Edwards.
Hey, I said neutral to negative. I didn't say just neutral. I'm not taking the Swiss. I'm not taking my Swiss residency to heart fully yet.
I mean, look, it's this is a conversation. While we enjoy doing this conversation down the pub, and it's an interesting one to have. IP week will be interesting. Weighing up the room to see. Are there more buyers than sellers? I can form more arguments to buy energy and structure. And freight than I can to sell in either of those. I don't think that there are many outright sellers. So yeah, it's a puzzling one. I mean,
well, it's a puzzling one, but you just said it right there. Is that there's so many people lined up on one side of the coin, the bullish side, that it kind of comes down to how can you get the market to move higher unless you have people who are willing to sell it. So you have to trade.
Market loves a market.
So and it is almost the point. At least I see the actual impetus that there could be a correction in the marketplace that becomes rather quick and rather hard. As you said, that one piece of data that comes out that pivots the market sentiment one way or another, as we saw Friday with the jobs report. That one little piece of data, you wouldn't expect to see a $4 sell-off on crude. But that job report caused a $4 sell-off in crude because everybody went back to a more risk-off, neutral stance. And so, and with everybody lined up on one side of the coin, or at least a lot of analysts are lined up on. It's hard to find the dissenting voice in the marketplace on Chinese demand. You do get a market that could be prone to massive downside corrections just because people want to get out when a piece of data comes out that doesn't align with that story.
Okay. Just moving on a moment, I want a question for you. One that I'm pretty sure every listener, which will have a vested interest in the energy markets anyway. If you don't have any vested interest in the energy markets, you are also very welcome on this podcast. Like, comment, subscribe. How does Russian oil get shipped? How does it get insured? How do they get on a P&I club? I don't know how to answer this question. Can you help me?
Well, so you have to think of it from the price cap's perspective, right? The price cap allows you to have access to EU financing, EU insurance, EU shipping, EU trading, EU brokerage. That whole price cap mechanism gives you that allowance. The price cap is a non-declarative item, i.e., you don't rock up to a Russian port and say, by the way, I'm loading price-capped oil. Please load my ship. The onus is on the person who is buying the oil to provide the documentation upon request from the regulatory authorities, like OFAC, that the oil was procured underneath the price cap based on the invoice that I received.
Hang on, sorry. So let's say you're a ship owner operating out of the EU,
Yep.
London. Someone says, I've got a cargo loading from Primorsk and it's
Yep.
going to discharge into Singapore. And the trading company is based in London as well. Are they allowed to do that?
From what my understanding, I'm not a legal authority, but when I read the OFAC requirements, yes.
Really?
Now,
Okay.
under UK law, that could be a different animal because the UK is its own separate jurisdiction versus the United States. And I have not read the UK rules. Don't get me wrong. But say, let's take the company out of being in London. Let's take the company being based in Dubai.
Yeah, okay, all right.
Okay,
Yeah.
so a Dubai company buys a Russian cargo. They book a EU-owned and operated vessel. They go to a British P&I club to insure the cargo. They go to a British bank to finance the cargo. Now, all things being equal under the OFAC rules, as long as they have in their possession an invoice showing that that cargo they bought was underneath the agreed to price cap, then everybody's free and clear. As a ship owner, you receive an LOI from the cargo saying that this cargo was produced under the price cap. As the insurer and as the broker who might be involved in the deal, you receive the invoice. So you also have your documentation showing that you were involved in a trade of Russian oil that was done under the price cap.
Hang on. But let's say you're paying Lukoil PJSC in Moscow and it's a dollar bank. You can't pay that UK bank, even though it's under the price cap, can't pay an entity in Moscow in dollars.
Well, that's
or
fine,
sterling or euros.
But the entity could be in Dubai, and if the buyer is in a Dubai-based entity area where they're banking in Dubai, and they're banking in a non-EU jurisdiction, then they can make those transfers happen, and those transfers will be allowed
in dollars.
That's my understanding when I read the OFAC requirements. Again, anybody who's listening to this, get your own legal opinion. I am not a lawyer.
Get your comments down here. Yeah, exactly. Any lawyers who specialize in the Russian sanctions price cap, please, I hope you're listening and can you comment? But this is what I mean. I'm not playing devil's advocate there, or was I being obtuse? These are legitimate questions that people are asking everyone's like, I'm not so sure. I don't know.
Is that because the price cap is not so you have the US OFAC is one entity that's trying to regulate it. And then you've got your individual jurisdictions of the UK, the EU, which have their own rules that are aligned with the US, but might have slight nuances that are different in what they allow and what they don't allow.
Okay. No, look, this is like we said to start with. It's just, it will happen. It's just, a new conduit will form, a new structure will establish itself, and that's how you do it. It's just a little vague as to how it's happening. And
it is happening because oil's moving, and you can pick yes or no. Is that oil moving on the dark fleet or moving on clean fleet ships? It's very hard to ascertain how it's moving, but there is a fair amount of oil moving on EU-owned vessels. And so based on the FOB price that Urals and some of these other products are labeled at, and they're all below the price cap level, you have to assume that they're using the price cap record retention mechanisms as labeled out in OFAC and the EU to make sure that trade happens and everybody's protected and nobody's going to be prosecuted at a later date.
Okay, so let's say you just loaded the cargo out of Russia. It discharges in I don't know the Med somewhere, and then your next fixture is from the Med into the Gulf Coast. And the Coast Guard, you send them your documents, last 10 cargoes. Oh, look, you've just called it Russia. Would that vessel be blacklisted?
That's a very good question. I think that comes down to the individual companies that are using the vessels. I mean, some companies might take a proactive approach and say, "Hey, we're not going to touch any vessel that's traded in Russia for 90 days, 180 days, whatever," just as a way to
Okay.
give a protective bevel around it. I mean, so there are those knock-on effects, and especially I think if you're doing something where you go Russia to Med voyage wouldn't really be allowed because the EU has the embargo on Russian oil. Now, if you took Russian oil, say to Egypt, discharged into Egypt,
Yeah, exactly.
and then you
Yeah.
went off and did another voyage, and you came to the US, as long as as the vessel owner, as long as you have what I gather is an indemnity letter from the prior cargo that was the Russian origin, theoretically you're protected because the trader says, yes, this cargo is being done under the price cap and has been purchased below the price cap level. You're indemnified.
Okay. All right. Well, look, let's wait for someone to mess that up. Some owner gets his boat arrested, and then we'll be used as a case study to apply on a legal. No, but it is I don't want to use the word fascinating. It's totally the wrong adjective for what is a very grim reason as to why we're having these very discussions. But it is a game changer, and it's interesting to see what's going to happen. But just before we wrap up, what effect is all this having on freight? Are you seeing a clear detachment in the market for, okay, if you want to go from ARA or your crude cargoes from Rotterdam into China, freight is absolutely roofed because so many tankers are being taken off the market, or is it steady?
I'm going to say that freight on the VLCC Suez markets looks like it's trending higher, but it's a slow grind higher. So it's not like it's a rocket ship just bouncing up. It is a supported market, and I think that market's going to remain supported just because of the longer ton-mile voyages that are now happening to supply, the crude that needs to be supplied. I mean, if you look at Europe needs 13.5 million barrels a day of crude imports via pipeline and via waterborne. So if you back out the 3.5, 4 million from Russia, that 3.5, 4 million have to come from somewhere else. Therefore, it's a longer haul crude. Therefore, you have the longer ton miles. Therefore, you have supported tanker markets. I mean, it is that case around. And when you start looking at the clean products, you're going to have the same issue there when you're looking at the export of clean products out of Russia to ports that can receive those goods. You're adding an extra 15, 20 days of voyage time when that voyage was only 6 days. So that incremental extra ton miles should provide support to the clean market and the dirty market because Russia exports 700,000 barrels a day of dirty products, which needs to be transported on dirty tonnage. So those two items alone should provide at least a floor to clean freight and dirty freight, at least until some point when the situation is resolved.
Yeah, I mean, look, you use the example of Indian buying, crude buying. They bought January 2022, India bought 1.4 million barrels of Russian crude. January 2023, they bought 43 million barrels of Russian crude. So what does that mean? That means, okay, well, obviously it's cheaper, but that means it displaces a current supplier, probably Iraq. So this is what I'm saying earlier. Basra medium should be going into Europe, and I think it will be more expensive. So I agree with you. I think freight, Suezmax, VLs, the big tubs, I think that they will stay supported throughout the rest of the year.
And the one thing that is I think poignant in all that is OSPs. So Saudi gave out their OSPs. Now a lot of analysts are saying, oh, because they decreased the OSP to China, or they didn't increase it as much, therefore there's so much demand in China, they want to keep that flow going. I'm going to flip that argument on the head, saying they increased the OSP into Europe. So if they're losing market share because the Russian crude is flowing into the east, and that is far more volume and at far cheaper price, they know they'll never, ever compete. But they know that the Europeans need 13.5 million barrels a day of crude imports, and therefore you've got a captive market that can take in your crude. You might as well jack up the OSP into Europe and say,
absolutely,
if you want my crude, pay me a higher price.
Optimization.
Yes, exactly. But nevertheless, it's coming to another end of a Smoking Barrel podcast today. So, as Matt said earlier, like and subscribe. Leave your comments
Like,
down
comment,
below,
subscribe.
and
Yeah.
we'll look forward to speaking to you next week.
Cheers. Cheers, Barrel Boys.